Hold onto your hats because calls for a jumbo Fed rate cut are gaining real steam. The latest inflation data sent doves cheering across Wall Street. But let's not kid ourselves. Our numbers haven't exactly been trustworthy. See, if the Bureau of Labor Statistics hadn't spent the last couple of years feeding us fairy tales, inflated data, we might already be enjoying real rate cuts instead of just talking about them. Here's something for your inner finance nerd. The spread between the 10-year Treasury yield and the 30-year mortgage rate is still way above normal. Historically, that gap sits around 1.5% to 1.75%. Lately, it's been closer to 3%. That's a massive extra premium you're paying on top of Fed policy just for the privilege of buying a home. The good news is that spread is finally starting to narrow, giving us plenty of room for mortgage rates to follow the 10-year Treasury lower. That's where yield suppression meets real relief and where homebuyers start winning again. And for those of you ready to chime in with, well, the Fed doesn't control mortgage rates. Okay, you're right. Mortgage rates track Treasury bonds more closely. Here's the kicker. The 3-month Treasury rate almost always matches the Fed funds rate, and the rest of the curve fills in from there. If the Fed turns more accommodating, mortgage rates will follow down. So yes, inflation data is backing the doves, and yes, we need that jumbo-sized cut. But whether it happens or not depends on whether the Fed admits the BLS numbers were part of the problem, not the solution. Follow me to master your mortgage, because when the Fed finally catches up with reality, you'll want to be ready.